jumped 28% this morning. The company that Wall Street left for dead, the company that missed out on the cell phone, that lost the GPU, that lost the foundry race. Intel, 28% in one session. So what happened? AI demand for CPUs just hit a level nobody expected. Texas Instruments surged 19% yesterday on the exact same story. AMD is up 11% in sympathy, $48.7 billion in equity flows this week, 17-month high. This is all money, a lot of it, chasing AI. This is the Morning Burr, and I'm Garrett Baldwin. The AI trade just went ballistic. Welcome to the show, everybody. It is, well, what day is it? It's Friday. That's exciting. I'm excited. I don't know why you wouldn't be. And we just got some new cameras, which means you could see every pore on my face. I don't know if you asked for that, but hey, we're about it. We're going to dive into today, as always, key things that we're going to be focusing on. Again, as the big idea, and that is that the AI trade has gone absolutely bananas. Going from, in 2 years, the AI trade was 7 names. Remember that: NVIDIA, Microsoft, Meta, Google, Amazon, Apple, and of course, Tesla. Well, what is happening now? It is expanding out, and that has changed. And Intel just reporting Q1 earnings, beat on revenue, beat on EPS, raising its guidance. The data center growth is accelerating. The foundry demand is coming back, and advanced packaging demand is absolutely surging. The stock jumped 28% pre-market. That's the single biggest move for Intel in over a decade. Meanwhile, in Texas Instruments surging yesterday, best one-day surge in 25 years for TXN. This is on analog chips, not even the sexy part of AI. This is the infrastructure layer, the plumbing beneath the plumbing, and it went up 19%. $48.7 billion was in equity flows this week. This is a 17-month high. TSMC and SK Hynix both hitting all-time highs. The SOX Semiconductor Index is on a 16-day winning streak. And of course, that is a record. The AI bid is broadening. It is no longer about 7 names. It is about the entire supply chain. Legacy chips, analog chips, packaging, memory. The demand is so big, it's lifting everybody. But here is the one thing you need to hold on. The AI trade is broadening within tech. It is not broadening across the market, and we will come back to that in a minute. As always, what you get out of this show, you're going to get the tape. We're going to talk about what's moving before the open and what's chasing its own tail. The big idea: one trade, one thesis, not 10 opinions, one you can actually use. Today, we're talking risk and macro, what can break that trade, and the big lesson, the concept that helps upgrade how you see this game. Remember, the narrative is the costume in news. Most people stop there. We follow the plumbing of the financial system. This morning, pretty simplistic day. NASDAQ leading the futures this morning. NQ's up about 0.9%. Intel, AMD, TSMC, all doing that heavy lifting. The S&P 500 futures are basically flat. Dow futures are slightly negative, down about 0.3. The big story, of course, remains oil. 5 straight days higher. We've pushed to that key level on the OILU, a signal of bullishness in oil prices. Brent is at $107 a barrel, and WTI pushing toward that $100 level. This is the biggest weekly gain for Brent since the war started, plus 17% on the week. Meanwhile, gold is drifting lower around 4,700, still getting sold. The inflation trade is beating the safe haven trade right now. Bitcoin is holding above 77,000, and that's important because it's telling us that liquidity conditions remain ample, so momentum remaining strong. The VIX is currently around 21. That is elevated. The weekend risk premium is now in play. This is going to be a day to really bring things down to just the next few trading hours. Think about the positions and go back to those questions that I always encourage you to ask. Why do I own this stock? And if you don't have an answer for that within about a minute, then you need to consider all of the other impacts of that, of what the opportunity cost would be, and whether or not you're willing to go through the potential volatility that may be coming on the backside of May. Meanwhile, Europe is down about 0.5%. Obviously, Mideast tensions remain the challenge. Weak German data is the IFO data was pretty weak. Asia was mixed. The Nikkei caught up to Thursday's sell-off. Key events today: The University of Michigan's final sentiment at 10 a.m. This is the consumer sentiment. The S&P 500 is going to all-time highs, and consumer sentiment is at levels we haven't seen in decades. So this is expected to crater to 47.6 from 53. One-year inflation expectations are expected to go to 4.8%, pretty much wiping out any expectation of a rate cut anytime in 2026. And now we have to start looking at 2027 on the calendar. Companies reporting today: Procter & Gamble, HCA, Norfolk Southern, and SLB. Pay very close attention to SLB. This is not just about the oil drilling space. It's also about geothermal moving forward. So far as the framework goes, we have oil moving higher for its fifth straight day. Brent pushing to 106, touching 107.48. Again, the biggest weekly gain since this war started. And we thought that this was the last of it. But as we know, this war continues to be a game of narratives and continuing shifts in sentiment. The core story here, which remains the same, right? Intel surges, goes up and has a huge day. But now we have the focus on the commodity side, and that is what can really impact the consumer spending. And of course, the OILU, as it continues to break out, is problematic for the S&P 500. Brent topped 107, WTI moving toward that 100. The Strait of Hormuz is still effectively shut. And here's what you have to understand about the weekend. 3 U.S. aircraft carriers are now being deployed to the Middle East. That is the most since the start of the war. The Pentagon is reportedly developing plans to target Iran's Hormuz defenses if the ceasefire fails. CNN reported this as well. Israeli media is reporting that a limited operation against the Iranians may be carried out in order to avoid a prolonged war. But Iran's VP has said any attack on oil wells will be met with strikes on the attackers' oil facilities, basically beyond eye for eye, and that is a direct escalation threat. On the supply side, Japan announced it will release 5.8 million kiloliters of national oil reserves starting on May 1st, and JP Morgan is deeply concerned about the math right now on where oil is going to flow. The expectations and the concerns is this can really ratchet up very quickly in May. Right now, EU leaders are tasking finance ministers with new energy shortage measures because current proposals are not enough. Imports on Russian fuel oil to Singapore have doubled this month. Everybody is scrambling. Japan is buying from Mexico. Cats living with dogs. The weekend is the risk. Position yourself accordingly. The key lesson for today is breadth. And every day we try to focus on one term, one idea, one concept. And this is definitely the one that we have to watch, particularly with the S&P 500 at records, because it tells us something that a lot of people hear about, but they don't understand, and that is breadth. So think of the market as a parade. The S&P 500 is a parade. Sure, right? A parade, 500 companies are supposed to be marching down the street. Breadth measures how many of those companies are actually marching. Wide breadth means most of the 500 companies would be moving higher together. That is a healthy rally. That is what we measure over at Money Printer Pro with our cap weight side. And we have for our elite members 502 stocks, all measuring momentum and their strength across multiple academic studies. This is a fragile rally because narrow breadth means only a handful of the companies carrying the index are moving while the rest are falling flat. So in a fragile rally, how do you measure this? There's two ways to do this. The first is the advanced decline line, which tracks how many stocks are going up versus how many are going down on a given day, and the percentage of stocks trading above their 200 moving day average. These are the most common ways to do it. Now, we have a more advanced way that we like to focus on this, but here's the key thing. The S&P 500 is at record highs. Breadth is at its narrowest since the dot-com bubble. The Magnificent Seven are massively outperforming the other 493 stocks in the index, and the parade that was 500 names on the banner, only 7 are actually working. The history behind this is actually pretty simple. Right now, you go back to The last time it was this narrow, it was March 2000. That was right before the dot-com crash. When else did it happen? July 2007. You know what happened nearly a year later, right before the financial crisis. Now, does a narrow breadth mean there's going to be a crash tomorrow? Of course not. As you can tell, the markets can remain solvent or irrational longer than you can remain solvent. And it's one of the reasons why we continue to advocate and focus on following breadth through a different way. The way that we do this is over at Money Printer Pro. So what we do here is we have a cap weighting for the market. And as you're going to see right here, the traditional way that we have long measured momentum, particularly at the academic side, was taking the number of stocks that were breaking out versus the number of stocks that were breaking down. Up 5% on the week, just up on the month, beta of 1 to 2, minus the number of stocks that are down 5% on the week, down on the month, beta 1 to 2. What we did was we added a measurement that here is equal weight. That would treat every single stock on the S&P 500 equally, right? So Apple is up 5% on the week, up on the month, but a much smaller stock, a McCormick, is down on the week, down 5%, down on the month. They would effectively count one another out. If you add a cap weight, if you focus on the cap and you see the cap weight being significantly higher than the equal weight, that tells us that stocks with a much higher market capitalization are dragging the S&P 500 higher. In fact, the cap weight is now double the equal weight, which means these equities that are pulling this thing higher are doing so at a 2-to-1 level. The breadth is extraordinarily strong as well on the Russell, right, in terms of the cap weight, but the breadth remains very, very narrow. All of this is very critical. It's extraordinarily important because there's an irony to all of this. We know that the markets can stay narrow for months, but it means the foundation is thin. A market standing on one leg can stand for a while, but when it falls very fast because there's nothing else holding it up. And that's the key lesson that you need to understand, is that when we really assess this market and really understand what's going on with it, you have to recognize repeatedly that these declines are usually leverage leaving the system. And then you see a name like NVIDIA fall somewhere between the range of 30 to 33% in 2.5 weeks, like it did in August of 2024. These stocks that are heavily owned, the companies that are pushing everything higher because of their cap weighting, they are then deleveraged and they fall very, very quickly. Now, we want to be very, very cautious about this, which is, again, why we have the signal that we have and why we follow what we follow. But at the end of the day, the thing that I want you to just keep in mind here is, with today's Intel story, the AI trade is broadening within tech, but more chips companies are participating. It's narrowing across the rest of the S&P 500 and the rest of the market. The rotation is into AI and out of everything else, and it is indiscriminate about earnings ratios, whether or not the PEs are too high. This is not breadth widening. This is breadth concentrating in a very specific shape. So watch the advanced decline line. Watch the percentage above the 200-day moving average. That will tell you whether this rally is real or standing on one leg. And just recognize that the last time that this was this stretched, we had two significant financial events that transpired in 2000 and, of course, post-2008. Catalyst before the close. Once again, reminder, University of Michigan Sentiment Index at 10 a.m. Final sentiment is expected at 47.6. One-year inflation expectations at 4.8%. This is the consumer fear gauge. You have earnings in Procter & Gamble, HCA, NSC, Charter, SLB, all reporting. These are consumer staples and rails and energy services. Next week, the Federal Reserve is on tap. The Fed's on a blackout. The rate decision is Wednesday. Pretty much 0% chance of a cut. This is about guidance. This is about understanding other elements of the railing in the financial system. The market is pricing the status quo, but oil complicates things. Israeli media reporting that a limited Iran strike is possible. That third carrier has been deployed. No talk scheduled. Brent's at 106, moving to 107, up on the week. Oil for oil is the attack line from the Iranians. and Japan is releasing reserves. And finally, the narrowest breadth since 2000 and 2007. The AI bid is broadening. We want to keep a very close eye on the SOXL. The SOXL is, of course, the bullish ETF for semiconductors. If you just watch this line, I'm going to show you what it is. Here's your breadth line, by the way, SMA, all stocks in the broad market. But SOXL is the one that has been absolutely driving this mania, largely on the backside of the momentum switch that happened on our signal on April 7th, 51 to 125 on the daily bull ETF. This is running extremely overbought, but it is a reminder that the market is not the economy and the economy is not the market. This market continues to chase, continues to chase, continues to chase. As you can tell, we have some new lighting around here and also a camera that is piercing through my body. I hope everybody has a great day. If you have questions, you know where I am. Check out Money Printer Pro. Check out the link below. In addition, reminder, I will be coming out with postcards from the edge of the world on Sunday. If you have any other questions, you know where I am. Stay positive.